Big Four Accounting Advisory for M&A, Interview Preparation, Part 1, Updated and Detailed. Welcome back to the channel. Today we're diving into accounting advisory for M&A, one of the most technical and highly evaluated areas in Big Four interviews. These questions come from real interview patterns across Big Four firms and global capability centers. Accounting advisory for M&A focuses on purchase accounting, fair valuation, consolidation, transaction structuring, and post-deal financial integration, all under IND AS and IFRS rules. Let's begin. End quote. How do you assess whether a proposed acquisition qualifies as a business combination or an asset acquisition under IND AS 103 or IFRS 3? Sample answer. I start by applying the input plus process, output model. If the target provides both inputs and substantive processes capable of producing economic benefits, it qualifies as a business. If not, it is an asset deal. I also apply the optional concentration test to see whether substantially all fair value lies in a single asset or asset group. While answering, always include inputs, processes, outputs, and the concentration test. A buyer acquires a company with significant intangible assets not recorded on the seller's books. How do you perform PPA? Sample answer. I identify intangible assets that meet separability and contractual legal criteria, such as brand, customer relationships, and technology. Then I perform fair valuation using cost, market, or income approaches. The residual balance becomes goodwill. While answering, always include identification, valuation approach, and goodwill calculation. End. How do you identify and measure contingent consideration in a business combination? Sample answer. Contingent consideration includes earnouts or performance-linked payments. I measure it at fair value using probability-weighted scenarios or option pricing models. It is recognized as part of purchase consideration and remeasured through P&L unless classified as equity. While answering, always include fair value method plus classification impact. A transaction includes earnout payments linked to performance. How do you determine whether they belong to purchase consideration or post-combination compensation? Sample answer. I check the primary indicators under IND AS 103, such as whether the arrangement replaces employee compensation, whether the earnout depends on continued employment, or whether it is linked to seller roles. If tied to future employment, it becomes post-combination expense. While answering, always include continued employment, purpose of payment, and technical indicators. How do you evaluate whether pre-combination contracts contain embedded derivatives? Sample answer. I review supply contracts, leases, and loan agreements for clauses that behave like derivatives, such as price resets, currency-indexed payments, or embedded options. If the embedded feature is not closely related to the host contract, I separate and fair value it. While answering, always include contract review plus closely related test. A buyer obtains control in stages. How do you handle step acquisition accounting? Sample answer. I remeasure the previously held interest at fair value on the acquisition date. The resulting gain or loss goes to P&L. Then I apply normal purchase accounting for the new stake. While answering, always include remeasurement, gain-loss, and post-acquisition PPA. How do you measure NCI using proportionate interest versus fair value method? Sample answer. Under the fair value method, NCI is recorded at full fair value, including its share of goodwill. Under proportionate interest, NCI is measured using its share of net identifiable assets, resulting in partial goodwill. While answering, always include goodwill impact plus choice rationale. A company reallocates goodwill among multiple CGUs post-deal. How do you assess allocation methodology? Sample answer. I ensure goodwill is allocated based on synergies expected from the acquisition, not on arbitrary percentages. The allocation must align with how management monitors benefits and how CGUs derive cash flows. While answering, always include synergy basis plus CGU linkage. How do you determine whether a transaction triggers recognition of bargain purchase gain? Sample answer. I recheck asset valuations, contingent liabilities, and consideration. Bargain gains only arise when fair value of net assets exceeds consideration after verifying assumptions. The gain goes to P&L. While answering, always include reassessment plus validation of fair values. A seller retains certain liabilities after the sale. How do you evaluate accounting boundary of the transaction? Sample answer. I determine which obligations are transferred and which remain with the seller. Only liabilities transferred to the buyer form part of the business combination. The retained liabilities must be excluded from PPA. While answering, always include contract terms plus transfer versus retain logic. How do you assess whether a pre-deal restructuring should be accounted for as part of the business combination? Sample answer. If the restructuring is initiated by the seller and completed before acquisition, it is excluded. If the buyer requires it as a condition of the deal, it becomes part of purchase accounting. While answering, always include who initiated plus who benefits. A buyer acquires only selected assets and employees. How do you evaluate whether inputs plus processes equals business? Sample answer. I assess whether employees transferred include key processes like production, sales, or management. If only assets move without processes, it is an asset deal. While answering, always include staff transfer plus process capability. How do you assess fair value of financial instruments acquired in a business combination? Sample answer. I classify instruments under IND AS 109 first. Then I fair value them using market prices, discounted cash flows, or option models. Post-acquisition measurement follows their classification. While answering, always include classification plus valuation method ... A target has complex contingent liabilities. How do you determine which must be recognized at acquisition date? Sample answer. Contingent liabilities must be recognized if they are present obligations and can be reliably measured, even if outflow is not probable. I determine best estimate using expected value techniques. While answering, always include recognition criteria plus measurement. How do you evaluate the impact of employee-related obligations on acquisition accounting? Sample answer. I identify pension liabilities, bonuses, leave encashment, and stock compensation. Each must be measured at fair value. Some items like replacement awards may go to P&L after acquisition. While answering, always include obligation identification plus classification. A deal includes indemnification assets. How do you measure and account for indemnification rights? Sample answer. I measure indemnification assets on the same basis as the related liability. Changes follow the same measurement rules unless they relate to collectibility risk. While answering, always include mirror measurement plus exceptions. How do you identify separate intangible assets from goodwill, brand, customer relationships, technology? Sample answer. I apply separability and contractual legal tests. If an asset can be sold separately or arises from contractual rights, it must be recognized separately. Goodwill includes only non-identifiable synergies. While answering, always include separability plus legal rights. A company has significant earn-in capital commitments. How do you evaluate post-acquisition treatment? Sample answer. If the commitment relates to conditions existing before acquisition, it may be considered part of acquisition accounting. If it relates to future expansion, it is expensed or capitalized post-acquisition. While answering, always include past versus future obligation test. How do you treat acquisition-related costs versus costs forming part of consideration? Sample answer. Costs like advisory fees, legal fees, and due diligence go to P&L. Costs forming part of consideration, like settlement of pre-existing relationships, are included in purchase consideration. While answering, always include P&L versus consideration boundary. A business combination results in deferred tax impacts. How do you calculate and record acquisition date DTAs? Sample answer. I compute temporary differences between fair valued assets and tax bases. DTAs and DTLs are recognized except for goodwill arising from initial recognition exemption. While answering, always include temporary differences plus exceptions. How do you treat pre-existing relationships between acquirer and acquiree? Sample answer. I settle them at fair value through P&L. Any settlement gain or loss is not part of consideration. The remaining amount forms part of purchase accounting. While answering, always include settlement first, then PPA. A buyer enters into replacement awards for acquiree employees. How do you determine acquisition date versus compensation expense? Sample answer. The portion replacing pre-acquisition service is purchase consideration. The portion linked to post-acquisition service is compensation expense. While answering, always include split between past versus future service. How do you evaluate whether to remeasure previously held equity interests at fair value? Sample answer. In a step acquisition, previously held interests must be remeasured at fair value. In partial disposals without loss of control, they are not remeasured. While answering, always include control test within. A company performs a reverse acquisition. How do you determine acquirer versus acquiree? Sample answer. I assess who controls the combined entity, board composition, voting rights, and governance. The legal acquirer may not be the accounting acquirer. While answering, always include control indicators plus substance over form. How do you evaluate lease classification and ROU adjustments when acquiring leases? Sample answer. I reassess lease classification on acquisition date. ROU assets and lease liabilities are measured at present value using current discount rates and adjusted for market terms. While answering, always include reassessment plus fair value adjustments. A business combination involves leases with unfavorable terms. How do you account for off-market lease adjustments? Sample answer. I compare the contractual lease terms with current market rates. If the acquired lease is unfavorable, I recognize a lease liability at PV of payments and record an off-market lease intangible liability equal to the difference. This adjusts the ROU asset as part of PPA. While answering, always include comparison to market, fair value adjustment, impact on ROU. How do you recognize and measure reacquired rights in an M&A transaction? Sample answer. If the acquirer previously granted rights, like franchise or distribution rights to the acquiree, reacquiring them is treated as an identifiable, intangible asset. It is measured at the value of remaining contractual terms, regardless of renewals. While answering, always include nature of right, valuation based on remaining term, amortization. A target's financials follow local GAAP. How do you convert to IND AS IFRS for acquisition accounting? Sample answer. I map each accounting policy and adjust for recognition, measurement, and presentation differences. For example, leases, revenue, financial instruments. Only after converting to IND AS, IFRS, do I apply purchase accounting. While answering, always include policy mapping, adjustments, conversion, PPA. How do you assess whether deferred revenue should be remeasured at fair value on acquisition date? Sample answer: yes, deferred revenue is remeasured at the cost of fulfilling the obligation, not the original billing amount. This often reduces deferred revenue because only direct costs and a reasonable margin are considered. While answering, always include obligation cost, fair value, impact on revenue, post-acquisition. How do you evaluate the effect of put-call options written over NCI? Sample answer: I assess whether the option creates a present obligation. If the parent has an obligation to purchase NCI, a financial liability is recognized at PV of expected redemption price, with offset to equity. While answering, always include obligation test, liability recognition, equity impact. A parent sells a partial stake but retains control. How do you account for changes in ownership interest? Sample answer: since control is retained, the difference between consideration received and adjustment to NCI is recorded in equity. No gain-loss goes to P&L. While answering, always include control retained, equity-only adjustment. How do you account for loss of control arising from a divestiture? Sample answer: I derecognize the subsidiary's assets and liabilities, remeasure retained interest at fair value, recognize gain, loss in P&L, and treat retained interest as per IND AS 109-28, depending on classification. While answering, always include derecognition, fair value remeasurement, P&L impact. A business combination includes market-based earnout conditions. How do you fair value contingent consideration? Sample answer: I use option pricing models like Monte Carlo simulations when payoffs depend on market variables, example, share price. The calculation incorporates volatility, time, and probability of achievement. While answering, always include option model, volatility, scenario simulation. How do you evaluate restructuring provisions that arise after acquisition? Sample answer: only obligations existing at acquisition date are included in PPA. Plans initiated after acquisition date are post-combination expenses. While answering, always include initiated before versus after acquisition date assessment. A group reorganizes legal entities before merger. How do you determine whether a common control transaction applies? Sample answer: I determine whether the entities are under the same ultimate parent both before and after the transaction. If yes, it is a common control transaction and accounted using pooling of interest method. While answering, always include same parent test, pooling approach. How do you prepare merger accounting entries for pooling of interest treatments under common control combinations? Sample answer: I combine book values line by line without fair value uplift. No goodwill is recognized. The difference between share capital issued and net assets acquired goes to capital reserve. While answering, always include book values only, no goodwill, capital reserve. 5. A seller provides escrow deposits for indemnities. How do you account for escrow arrangements? Sample answer: if the escrow belongs to the buyer, I recognize an indemnification asset. If contingent, I measure it similar to the related liability. The escrow itself may be treated as restricted cash. While answering, always include ownership test, indemnification treatment. How do you assess acquisition date fair value of inventory, including step-ups? Sample answer: I measure finished goods at selling price minus costs of disposal and profit margin. WIP is valued based on completion percentage. Step-up differences go into COGS post-acquisition as inventory is sold. While answering, always include valuation basis, step-up, impact on post-deal margins. A buyer wants to accelerate revenue recognition through acquisition adjustments. How do you challenge? Sample answer. I ensure that PPA does not override IND AS 115 principles. Deferred revenue must be remeasured based on cost to fulfill, not manipulated to increase revenue. I document judgments and challenge aggressive estimates. While answering, always include revenue principles, fair value discipline, challenge approach. How do you evaluate recognition of acquired deferred tax assets, DTAs? Sample answer. I check whether sufficient future taxable profits exist. If not probable at acquisition date, the DTA is not recognized. However, it can be recognized later with P&L impact. While answering, always include probability test, recognition timing, acquisition date constraints. End. A buyer discovers post-acquisition errors in the acquiree's books. How do you treat them? Sample answer. If errors existed at acquisition date, I adjust PPA retrospectively within the measurement period. If identified after measurement period, I treat them under IND AS 8 as normal error corrections. While answering, always include measurement period versus post-measurement period treatment. How do you assess classification of acquired financial liabilities under IND AS 109? Sample answer. I analyze contractual terms, interest rate reset features, embedded derivatives, and settlement options. Classification is based on contractual cash flow characteristics and business model test. While answering, always include SPPI test, business model, fair value at acquisition. A company is acquired mid-year. How do you determine pre-acquisition versus post-acquisition income? Sample answer. I perform cutoff testing at the acquisition date. All income expenses before acquisition belong to seller. After, go to the group. I also split transactions like revenue, payroll, and depreciation proportionately. While answering, always include cutoff, allocation, consistency with controls. How do you prepare acquisition date opening balance sheet for consolidation? Sample answer. I bring in acquiree's IND AS IFRS adjusted balances, apply fair value adjustments, recognize goodwill, align accounting policies, and eliminate intercompany items. While answering, always include policy alignment, fair value, goodwill, elimination entries. A target uses significant estimates. How do you align accounting policies with group GAAP? Sample answer. I review estimation methods, useful lives, provisions, revenue recognition, and ensure they conform to group policy. Adjustments are made in PPA. While answering, always include policy comparison, adjustments, documentation. Thank you. How do you evaluate whether reacquired assets should be amortized over remaining contract period? Sample answer. Reacquired rights must be amortized over the remaining contractual period, not renewal period, because renewal is not guaranteed. While answering, always include contractual term only, no renewal assumption. A business combination includes contingent assets like litigation wins. How do you assess recognition? Sample answer. Contingent assets are not recognized at acquisition date unless recovery is virtually certain. If not certain, they are disclosed only. While answering, always include virtual certainty threshold. How do you evaluate whether dual listed entities should be combined for accounting? Sample answer. I assess whether they operate as a single economic entity, shared control, unified governance, and common management. If substance shows unity, treat as a single reporting entity. While answering, always include governance, economic unity, and substance over form. How do you prepare advisory memos explaining judgments in complex M&A transactions? Sample answer. I document issue, analysis, technical references, conclusion, impact. The memo must explain judgments clearly, reference IND AS IFRS paragraphs, and show alternative views considered. While answering, always include structure, technical citations, rationale, also. How do you support finance teams in integrating acquired entities into group reporting? Sample answer. I help align accounting policies, reporting calendars, consolidation templates, intercompany processes, and chart of accounts. Training and integration checklists ensure smooth month-end reporting. While answering, always include policy alignment, templates, training, governance. Thank you for watching, and if you liked our video, kindly press the like button and leave us a comment. This will help us reach a wider audience. Don't forget to check the playlist for more great learning.